IRS Form 1040 SR. This is the U.S. income tax return for seniors. And for 2024, there are some changes. We'll walk through, what each of these fields means. Unfortunately, because an income tax return is so vast, we're going to have a lot of areas where we make references to other forms and schedules that we won't cover here. If we've done articles and videos on those forms and schedules, you can see links in the show notes to those resources that we've created. And we do have resources for most of those items. As we go through the 2024 tax season, we will be updating our articles and videos accordingly. So keep your eyes open, stay tuned. We're trying to time our updates with in accordance with the order that the IRS is updating their forms and instructions. So what we're going to do is we're going to go through this form as if, our fictional hero, John Doe, is a senior citizen. Of course, you have to be age 65 or older to complete Form 1040 SR, but there are a couple of differences. Namely, it's a little bit bigger font, and it's a little bit more simple. It replaces what used to be known as the 1040EZ for people with relatively simplified tax situations. So, but we've broken this down into certain areas. So we'll talk about the taxpayer information fields, the filing status, digital assets, and standard deduction fields in the middle, dependent information, items of income, which go all the way through line 15, tax and credits that go from line 16 to line 24, and then payments, which covers the rest of the form. And finally, on the last page, you'll see refund or the amount that you owe, plus the signature section. So we'll cover each of these bit by bit. Let's go ahead and start at the top with the taxpayer information. So up here, these blanks here would be for a fiscal year taxpayer. For example, if you are a sole proprietor and your tax year is along the lines of the federal government's fiscal year, which runs from October 1st to September 30th of the following year, then you would enter those months here. So our couple is just a normal, regular taxpayer family. John and Mary Doe, we've put their names and information here, their home address. You can, if you live in a foreign country, you would put the full country name or the province or the state or county, and then the postal code. Presidential election campaign, the instructions specifically state that this money does not come out of your tax return, which I guess is a good thing, but you can select either that for yourself or for your spouse. It won't change your refund if you do that or if you don't do that. So the first question a lot of people have is whether or not they need to file a tax return in a given year. And there is a chart in the form instructions. We'll kind of lightly go over the requirements. So if you if you earn a certain amount of income, or if you have certain tax benefits or tax treatments, then you would need to file Form 1040 or 1040 SR. So if you owe any special taxes such as alternative minimum tax, any additional taxes on a qualified plan, household employment taxes, Social Security and Medicare taxes on tips that you did not report to an employer, uncollected Social Security or Medicare taxes, or recapture taxes, you would need to file a tax return. If you or your spouse filing a joint return received distributions from a health savings account, an Archer MSA, or a Medicare Advantage MSA, you would have to file this tax return. If you had net earnings from self-employment of at least $400, you have to file. If you had wages of $108.28 or more from a church that is exempt from Social Security and Medicare, you would have to file this tax return. If you received advance payments of the premium tax credit, you would need to file. If you, there are certain other items of income under Section 965 that if you declare them, you would have to file. Or if you purchased a new or a used clean vehicle from a registered dealer and you reduced the amount that you paid at the time of sale by transferring your tax credit to the dealer, you would have to complete your tax return to reconcile that. You would also need to file if you meet certain income requirements that are listed in the form instructions. So if, for example, if you're 65 or older for 2024, if John and Mary Doe had income of at least $32,300, they would need to file. So for most people, if you have all of your net worth in a Roth IRA and you're only collecting Social Security, you may or may not have to file a tax return. But most people kind of have a general sense of if they have to file. This really is more for people that might have recently retired or had a significant change in their income for one reason or another. So there are filing requirements. If you think that you might be below the filing threshold, then definitely check out either our article or the form instructions. So some of this depends on your filing status. You can select single, married filing jointly, married filing separately, head of household, or qualifying surviving spouse. So in this case, John and Mary Doe are married couple filing a joint tax return. We do break down all of these other statuses in our article, so check that out if you need more information. There is additional information you may need to provide if you check the married filing separately, head of household, or the surviving spouse blocks. So just below the filing status, there is a section for digital assets. So if you don't work with digital assets such as cryptocurrency, non-fungible tokens, then you probably don't need to worry about this section. But if you have, a relative that's got you invested in crypto, then you should at least pay attention to the form instructions to see if any of that applies to your situation. And specifically, the form instructions have some guidance on, what this means. So if you had either items of income from cryptocurrency, if you received in payment any kind of digital assets. So if someone paid you in crypto, if you exchanged it, if you sold it, if you otherwise disposed of crypto, then you may need to check out the digital assets section and simply just check yes or no. There is additional guidance in that section. Under the standard deduction, you can list whether or not someone can claim you or your spouse as a dependent, if your spouse itemizes on a separate tax return. And then there's also the age and blindness test. So for people filing Form 1040-SR, either of you or both of you may have been born before, in this case, January 2nd, 1960. That for the 2024 tax filing season would put you at the age of 65. According to the IRS, that's the prescribed definition. And then if either of you or both of you are legally blind, then you would get an additional standard deduction. I'm going to circle back to the digital assets section for a second because the form instructions do specify certain instances where you would say yes. So you would say yes if you receive digital assets as payment for property or services provided, if you receive digital assets as a reward, if you receive them as a result of crypto mining or staking or similar activities, if you receive them as a result of a hard fork. Not sure what that is, but if you are aware of that, then you would need to declare that. Disposed of digital assets, either in exchange for property or services or in exchange for another digital asset, if you sold one, or if you otherwise disposed of them. So under those circumstances, you would need to just check yes that you did receive or that you had some assets, digital assets. However, if you just hold digital assets in a crypto wallet or an account and you did nothing with them, if you transferred them from one wallet to another wallet that you owned, or if you bought digital assets, then you don't need to report any of those transactions. So under dependents, you can list up to 4 dependents. If you need to put more, you would check the box and then list additional dependents. First name, last name, this would be John and Mary Jane's daughter, Elizabeth, who happens to be eligible for the child tax credit. If your child turns 17 in the year, then you might not be eligible for the child tax credit, but you could still claim the credit for other dependents. So, just be sure that you're checking the right one, especially if your son or daughter is aging out of the child tax credit. So these items of income, all of them are, you're supposed to report income from all sources. We're going to go through step by step, like where you would find this income and how it would get reported to you. So most people are familiar with forms W-2. For people that are likely to file Form 1040-SR, you should see other forms such as a 1099-R that would come from places like retirement savings account, like IRAs or your 401k. Anytime you receive a distribution from a retirement account, you would see a 1099-R. If you receive dividends and distributions from investments that you hold, you would see a 1099-DIV. So let's take a look at each of these items of income and kind of walk through what that would be. So for line 1A, this is your taxable income on your form W-2, box 1, right? So this is basically your income that's reported. And let's just say that John Doe retired earlier this year, but before he retired, he had $20,000 of income. And that was on his form W-2. On line 1B, this would be if you worked in someone's house as a household employee and they're not required to file a form W-2 because in 2024 they paid you less than $2,700. So let's just say that Mary Jane Doe earned $1,500 that would not have been reported on a form W-2. She would need to put that here. Well, actually, for math purposes, we're going to round this up to $2,000. Tip income that wasn't reported on line 1A would include any tip income that you didn't report, and then any allocated tips that are shown in box 8 of your form W-2. So they're not tip employees. They don't have tip income. We'll skip down to the next one. Line 1D is for Medicaid waivers. And just give me a second. I need to get back to the page where I had that on. So that would be Medicaid waiver payments that were not reported on your Form W-2. So this would also be the total of any taxable or non-taxable Medicaid payments, waiver payments, not reported on your W-2. If you both received non-taxable Medicaid waiver payments during the year, then you and your spouse can make different choices about including those payments as part of your earned income. That would also go through on your Schedule 1. So, take a closer look at your Schedule 1 if that's an issue. So we're going to say that, let's just say that they had $2,000 worth of Medicaid waiver payments that were not reported elsewhere. Taxable dependent care benefits from IRS Form 2441. So these would be dependent care benefits that were provided by your employer on IRS Form 2441. Certain amounts of those benefits can be provided on a non-taxable basis, but these would specifically be shown on box 10 of your Form W-2, and then you would use Form 2441 to see if you can exclude part or all of those benefits from taxable income. So let's just say that they were able to exclude everything but $1,000 from their taxable income. Employer provided adoption benefits from line 29. Again, this would be the same thing. This would be the taxable portion of any employer provided adoption benefits. And you would find that on line 29. That would be reported in box 12 of your Form W-2 with the code T indicating adoption benefits. IRS Form 8919, line 6. So if you happen to have received that, then you're probably going to know exactly what it is, but it is uncollected Social Security and Medicare tax on wage income. So if you have that, then you would enter the total of those wages from line 6 of that. So basically, anything that should have been on your compensation as if you were an employee, but your employer decided to treat you like an independent contractor. So basically making you responsible for that part of the Social Security and Medicare. It's not too common, but it does happen to people, particularly when they're going back and forth with their employer about whether or not they're an employee or an independent contractor. And so for tax purposes, the independent contractor would receive a Form 1099-NEC instead of a Form W-2. Line 1H would be other earned income. They could be strike or lockout benefits, excess elective deferrals that would be reported in box 12 of your Form W-2 and with retirement plan box checked in box 13. So if you contributed more than the amount that you're allowed to defer, then the excess would be considered taxable income to you. Disability pensions shown on Form 1099-R or any corrective distributions from a retirement plan also shown on a Form 1099-R. Line 1I is for non-taxable combat pay. So if you need, like the primary reason why people would enter non-taxable combat pay is if they need it to be included to calculate the earned income credit. So earned income credit, you have to have some earned income to qualify for it, but not too much. And the non-taxable combat pay is considered earned income for the purpose of calculating that tax credit, even though it's not taxed the way regular income is. So we're going to add up all of these lines right here and then we're going to put the total down here. So we've got $26,000 right here. So the rest of these here are relatively straightforward. Basically line 2A and 2B. 2A would be tax exempt interest for things like municipal bonds. That's the primary source of tax exempt interest. And you would see that on either Form 1099 INT or 1099-OID, original issue discount. So an original issue discount bond is a bond that's issued at the face value of its maturity, almost like a treasury bond that you pay $50 for, but it has a face value of $100. That's the way an original issue discount bond kind of works, and you're supposed to report the taxes on a yearly basis, even if you're not seeing any cash flow from that bond. So in line 2A would be the tax exempt interest, specifically from tax exempt bonds. Line 2B would be the taxable interest. And you could find this, or you could be reporting this on Schedule B, and then that would go from Schedule B to here. So let's just say that you had $2,000 of taxable interest. Of note, for people that are dealing with IRMA, which is the income-related medical adjustment amount, the Medicare adjustment amount, it's the income basis for increasing Medicare premiums for certain high-income taxpayers. So the calculation to determine whether or not you're subject to IRMA is based on your total income or your adjusted gross income, and then plus your tax exempt interest. So the primary reason why your tax exempt interest is reported here, not so that you pay taxes for it, but because it is considered for other things like phase outs and specifically for IRMA. So in line 3A and 3B, we're going to talk about qualified dividends and then ordinary dividends. Qualified dividends, so if you saw like this would be perfectly normal. This would mean that you received $5,000 in dividends total, $2,000 of qualified dividends, and the actual ordinary dividend portion would be the $3,000. So even though this says ordinary dividends, it's actually both ordinary and qualified dividends. Qualified dividends are subject to a preferential tax treatment, very similarly to like capital gains, long-term capital gains treatment. So you get the tax benefit of qualified dividends, and if you hold mutual funds, like you're not responsible for calculating how much of your dividends are qualified versus ordinary. All of that would be reported to you on a Form 1099-DIV from your brokerage firm, from your mutual fund company, or your custodian. So basically, you would also see those broken out in your Form 1099-DIV, the qualified dividends versus your ordinary dividends. So just be careful how you're reporting this. This is inclusive of this. So what you don't want to do is say that you have $2,000 of qualified dividends and $3,000 of ordinary $3,000 of ordinary dividends for a total of $5,000. That's not what you're telling the IRS here. In this statement, you're telling the IRS that you have $2,000 of qualified dividends and you have $3,000 of total dividends, so your qualified dividends must be $1,000. So be sure that you're telling the IRS the right story based on what's reported to you on your 1099s. IRA distributions, you will see for most people that have 100% of their money in a pre-tax IRA, and they took tax, deferral on all of it, then you would most likely see that your $10,000 IRA distribution is also a $10,000 taxable distribution. However, there are people that either make non-deductible contributions, and so that money is returned to them as a non-taxable amount. Now, if you contributed $10,000 after tax and $10,000 pre-tax into your IRA, and now you have a balance of $20,000, then if you wanted to empty that entire account, you would enter $20,000. That's your total distributions, but then the taxable amount is $10,000, not the whole $20,000. So this is usually the area where accountants can earn their money, but more likely than not, you're going to see this information reported to you on your 1099-R. And if you have issues with the 1099-R, if you think the tax treatment was different from what you expected, you should really take that up with the issuer of the 1099-R to make sure that what you understand of the situation is what they understand as well. And if you're not on the same page, then they should be able to reissue it, or they should be able to give you an explanation as to why they issued it that way. But once it's on the 1099-R, that gets reported to the IRS, and then the IRS is expecting those numbers to match what you're putting here. So, if you have 3 1099-Rs, the IRS is probably going to flag your return if something looks wildly different from what you're reporting here. Pensions and annuities, kind of a similar thing. You should get a 1099-R. So let's just say that you had $10,000 here and only $5,000 was taxable. Let's say this was $10,000 and the full amount was taxable. And then Social Security benefits. Most of the time your tax software is going to do this. If you're doing this manually, there is a Social Security benefits worksheet that you can walk through. And there's a video on Teach Me Personal Finance that walks you through how to use that. But basically, you would need to kind of calculate your income on a separate sheet and then put that, or kind of make some adjustments based on how much of Social Security benefits are taxable versus not. That depends on your income. So there's a worksheet that will walk you through that. So for most people that don't know, Social Security benefits are never fully taxable. Even the most high-income taxpayers will only pay taxes on 85% of their Social Security benefits. Many taxpayers will pay zero taxes on their Social Security benefits, and some may pay 50% or taxes on 50% of the Social Security. And then if you choose to use the lump sum election method, you can select this box here. Generally speaking, that's if any of your taxes were beneficial and they included a lump sum for an earlier year, you might be able to reduce your taxable amount based on the fact that you're electing the lump sum method because you received all of this money in 1 year for multiple tax years. In line 7, you're going to enter any capital gains or losses. Most people would calculate this on Schedule D. For general awareness, you can deduct up to $3,000 of capital losses against ordinary income. So let's just say that that's what they're doing. But most likely you're going to be filing a Schedule D. If you have capital losses that you need to carry forward from year to year, you definitely will be filing a Schedule D, because that's how you can keep track of your capital losses. So one of the most frequent questions that I had when I was a financial planner working with clients would be a client that had come to me, brand new client, and they would have 6 or 7 figure capital losses from prior bad investments or investments that dried up, and what could they do? Would be the biggest question, and most of the time, you're looking for investments that are earning money so that you can offset those losses and the gains. That's your biggest bang for the buck. But if you're looking to offset ordinary income, then $3,000 a year, you're going to have a lot of carryovers from your losses if that's the way you're doing it. Line 8, you would enter additional income from Schedule 1, line 10. So that's basically a long list of additional income. And then you're going to add all of these lines together, starting with 1Z all the way down. 2B, 3B, 4B, 5B, 6B, 7. So let's see, we've got 26,000, 36,000, 46,000, 48,000. So we've got $45,000 here. Now, adjustments to income. So if this was the additional income, these are all adjustments to income from line 26 of your Schedule 1. So we're going to put that here, and let's just say that that's negative $5,000. Once you make those adjustments to your income, we have now arrived at AGI, adjusted gross income. So this is when you talk about certain phase outs or other tax treatments, sometimes they'll talk about AGI or adjusted gross income. For example, with IRMA calculations, that would be the modified adjusted gross income. That's the AGI plus that tax-free interest that I was telling you about earlier, or the tax-exempt interest. So anything above this line is considered an adjustment to arrive at AGI or adjustments to AGI. Anything below this is an adjustment from AGI. So anything above here means that it lowers your AGI. All the IRMA stuff, you can get below your IRMA by, finding anything in here that's going to lower your income. Anything over here that lowers your income, it may lower your tax, but it's not going to do anything to your IRMA. So standard deduction, itemized deductions on Schedule A, that doesn't impact your IRMA. If you are eligible for the qualified business income deduction, the QBI deduction, either on IRS Form 8995 or 8995A, none of those impact your IRMA at all. So let's just say that we're going to take the standard deduction for 2024, and for both of them, there's a table in the form instructions based on whether or not you were born before January 2nd, 1960, and whether or not either of you is blind. So let's just say that for them, they're both over the age of 65, so their standard deduction is $32,300. They don't own a business, so they're not filing either Form 8995 or 8995A, and then they're going to they're going to basically combine these two fields. They get 32,300, and then we're going to subtract this from the 41,000, and that gives us let's see, 8,700. So $8,700 is their taxable income. Now we're going to go and calculate the tax and credits based on this. So let's take a look first at the line 16 instructions. So this is tax from your taxable income. IRS Form 8814 would be if your child has interest or dividend income and you choose to report it on your tax return, you would be using 8414. If you took a lump sum distribution in the tax year, that would be from IRS Form 4972. There are other taxes that you may also put in here. So that would be Section 962 elections, recapture of an education credit, taxes from IRS Form 8978, which is if you're in a partnership. One of the main differences is that you can actually ask the IRS to calculate your tax for you under certain eligibility requirements. So if you there is a chapter in Publication 17 that helps people understand who is eligible and who is not eligible, or what you can do. So the IRS can help you calculate your refund. However, if your taxable income is less than $100,000, then you are required to use the tax table. If your taxable income is $100,000 or more, then there is a tax computation worksheet that you would need to use in most circumstances. There are a couple of exceptions. If you use IRS Form 8615, that's for unearned interest for a child, or if you have the Schedule D tax worksheet. So if those special occasion or situations apply to you, we've created videos on how to walk through those worksheets. But I'm going to take a moment to determine the tax calculation from the tax table. I need to really find it real quick. So for this tax year, we've got $8,700, and for a married couple filing jointly, that means their tax is $873. Now, Schedule 2, Line 3. Schedule 2 is the schedule where you calculate all additional taxes. Line 3 consists of alternative minimum tax, as well as the any repayment of the advanced premium tax credit. So if you know that you're not subject to alternative minimum tax, which in this situation, their income really keeps them out of that. They're not subject to AMT at all, and they never took the premium tax credit, so we're just going to say 0 here. And we're going to add these two lines, 873. They have a child tax credit or a credit for other dependents. So let's just say that they have the child tax credit that's minus $2,000. And then Schedule 3, Line 8 is, so if Schedule 2 is for additional taxes, Schedule 3 is additional credits. So there's a long list of non-refundable tax credits that make up Line 8. We explain all that in our article, so you can find more detail in that in our article. But let's just say that we didn't have any additional credits here because we're already going to be at 0. So subtract line 21 from line 18. That gives us 0. They are not self-employed, but you would find additional taxes on line 21, Schedule 2. So we have 0 income tax. So this basically looks like my mother's tax return. Now you would use this section to calculate all of your taxes withheld. So most people, the W-2, let's just say that they had $2,000 taxes withheld. Let's say most people with a 1099 don't have taxes withheld. You can have withholding placed on retirement payments and things of that nature, but a lot of people don't. And then any other forms. So let's just say that this is $2,000. If you had estimated tax payments throughout the year, you would put them in line 26. Also, any amounts that you applied from prior year tax return, and I'll zip right down here really quickly because this is the line where you would get that information from. So if you're not sure whether or not you had part of a tax refund applied to next year's taxes, simply go back to your 2023 tax return, go check out the line 36. Whatever that number is should be the number that you put in here. So let's just say that they had $500 put into there. Earned income credit, these are all refundable tax credits. So the child tax credit and the credit for other dependents are not refundable. They're non-refundable tax credits. The additional child tax credit is a refundable tax credit. So I'll take a break right here to explain the difference between refundable and non-refundable tax credits. Non-refundable tax credits bring your tax bill down to zero, but they can't reduce your tax bill below zero. So, and I believe I recall that the child tax credit was 60% refundable tax credit. So technically, of the $2,000 tax credit, $1,200 of it would be refundable, and then $800 would be non-refundable. So if that's the case, nope, sorry, other way around. 1,200 is a non-refundable credit. 800, so 60% is non-refundable, 40% is refundable. So that's the way that would look if you were eligible for the full child tax credit, which includes the non-refundable child tax credit and the refundable portion known as the additional child tax credit. So you can do that. The earned income credit, the American Opportunity Tax Credit, all of these are refundable tax credits, so the non-refundable tax credit can only reduce your taxes down to zero. So we're already at zero tax right now. A refundable tax credit can actually generate a refund. And one of the more common questions that I receive is, how does that happen? Well, simply the refundable tax credits are considered in the IRS's eyes like a payment. So if you had zero tax bill and you paid $2,000 because you thought you were going to owe taxes, you're going to get that $2,000 back. So we've already got that. We've already got this money that we paid from last year that the IRS has just been sitting on. And now we've got this refundable tax credit. And let's just say that all of these other tax credits, Schedule 3, all of these, basically the primary tax credit that we're really looking at is this $800. Let's go ahead and just put this here. All of this gets added together. So it doesn't matter if this is $3,300. That's money that's going into your pocket. This is no different of a calculation than if you simply did this. It's the same calculation. So, taxes that you paid over and above your tax bill, any estimated tax payments, anything that's above and beyond your tax liability, which in this case is zero. So any taxes you paid, any refundable tax credits, any estimated taxes, all are going to go back to your refund. And so your refund is, if line 33 is more than line 24, it is, then you're going to subtract line 24 from line 33. We're going to get this $3,300. Now, if you want it refunded, you simply put in your banking account information. If you want to split this up into multiple accounts, you can do that on IRS Form 8888. Or if you want part of your tax refund to go towards Treasury bonds, you can also select that on IRS Form 8888. So when you complete Form 8888, it will ask you specific dollar amounts of how much you want refunded, to which accounts. If there's a mistake, it will pay the maximum amount of money to the first account that you listed, then to the second, and then to subsequent accounts. And if the calculation comes up short, then the shortage will come out from the last account that you listed there. So if you did attach Form 8888, check that box. But you're either going to ask for a refund, or maybe you ask for a $3,000 refund and you want $300 refunded back to you. So these two lines, 35A and 36, should add up to 34. Now, let's imagine this is the opposite. Let's imagine that you're not getting a $3,300 tax refund. You're getting you owe $3,300. So now you have to basically do the opposite math. So you would subtract line 33 from line 24. So let's kind of go back and so let's imagine that your tax bill is $3,300 and you made 0 tax payments during the year. So now you're going to owe $3,300, and then you're going to need to do additional math to figure out what your estimated tax penalty was, and you're going to end up having to file a different form with your tax return to be able to work through that calculation. So, and that's based on the timing of your tax payments or your estimated taxes, when during the year you paid them, and that would be on IRS Form 2210. So we'll put links in the show notes to that. But you're going to get to the bottom of IRS Form 2210, and you're going to have a dollar amount. It'll probably not be that big of a dollar amount based on the calculation, but let's just say it's $50. So that would actually be added back into this, and you would owe $33.50 into here. So the third-party designee information is if you want, like, your accountant or a tax attorney or a family member to discuss your tax return with the IRS. And then you would sign and date this. This information on the right-hand side is for what's known as an identity protection PIN. So if you've had a history of identity theft where someone's has used your tax ID in the past to file fraudulent tax returns, or if you think that your identity has been stolen, the IRS can assist you by assigning you an IP PIN or identity protection PIN, which is a new number that they'll send to you every year. I think usually either the end of December or the beginning of January. So just in time for tax season every year if you're enrolled in that program. And then you would sign, date it. Both spouses would need to sign if it's a joint return, and then your paid tax preparer will sign it as well. If you're using a tax preparer, most likely they're going to have you electronically sign everything, and then they'll just have little click boxes. Most people use something known as DocuSign to do that, and they have to have your permission on file to electronically file your tax return. So this is kind of a rough overview of a very simple, kind of straightforward tax situation, and hopefully you have a better understanding of where these items of income come from. It can be a lot more convoluted than this, and we do break down some of the details in our article. So you can check out the article on our website. We'll put a link in the show notes, or you can go to teachmepersonalfinance.com, type in IRS Form 1040-SR, and you'll see the article there. We'll also put links in the show notes to the various forms and schedules that we mentioned here that we just couldn't get into in more depth. We've created additional videos and articles that go into as much detail as you need to outside the scope of this video. So we'll put links in the show notes to all of those resources. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.